derivatives. I'll be frank with you, it's almost as hard to explain as it was for AIG to figure out value back in 2008. So let's go through derivatives again. It's this course is not about derivatives, but it's good to understand them a little bit, just a little bit through this course. We're not going to be derivative experts. I'm not going to on the final ask you. Not going to on the final ask you to do complicated derivative calculations. That would be unfair. Okay, so derivatives. Why do they even exist? The right reason is they're a hedge. They're a hedge against risk. And if done right, that's what they are. You want to hedge against changes in the price of commodities, foreign exchange, interest rates, etc. Now, what's happened over the years is at derivatives could be as simple as a futures contract, and as complex as anything that your mind can take you to. There are very, very complex derivatives that are developed one-off for an individual customer or client who has a very specific risk that they're trying to hedge against. And that's what investment banks do. They come up with a complicated product that they believe is a good hedge against that specific risk. It's arcane, meaning hard to follow. But if done right, it hedges against that risk. So what you're trying to do with the derivative is lock into an acceptable level of something. You know the interest rates today. You have a variable rate on an interest. You want to lock in on today's rates. You got to pay for that, though. And that's what a derivative does. Or the opposite. You're locked in on a rate and you want to kind of release yourself from that lock-in. And so you release yourself from an unacceptable level. A futures contract locks you into a price in the future for the receipt of some, let's say, a commodity. A swaps contract trades off a fixed interest rate for a variable interest rate or vice versa, depending upon what the customer is trying to accomplish. Every derivative has a few characteristics. It has an underlying price, for instance, the foreign exchange rate that you're locking into. It has a notational amount, which is a number of units that you'll be purchasing. It doesn't always require an investment. There's no money that trades hands at the point of the derivative. It's an exchange of promises for the future. So it's a mutually unexecuted contract at the point of agreement. And at the end, payment is a net settlement. Net settlement, meaning you just pay the difference. So if you had an 8% interest rate that was fixed, and there's a variable rate of 6% at the point of delivery, you would pay that 2% difference. So you pay the net amount. So accounting for derivatives. It would be recognized on the balance sheet as an asset or as a liability, and that is what your contract says. Periodically, it needs to be marked to market, and this was where AIG was challenged. Because these things are not traded on the open market with a very easy to determine price. The price has to be calculated. And if your mark to market is off, it can dramatically change values or misrepresent values. As you mark to market, the gain or loss as you do that revaluation goes to your net income or your other comprehensive income. There are three classes of derivatives. These two are fairly similar as classes. This one's very different. If it's a speculative investment, meaning you're purchasing it for the purpose of making an economic gain, the derivative is not a hedge in that case. It's an investment. Then you need to treat it like you would a marketable security that you purchase. It's revalued each period and goes straight to net income or not. Fair value hedges and cash flow hedges are used either to protect the value of an asset that you have, we'll talk about that in a moment, or to protect future cash flows that you're expecting from the sale of an asset. They have slightly different purposes. If a derivative is not specified as one of these two, it's assumed to be speculative. Okay, fair value hedges. So you're hedging an asset or a liability. An example would be an interest rate swap. You want to neutralize the fact that interest rates may change over time, and you want to neutralize that effect on a notes payable that you might have. Or an FX contract, because you're doing business overseas and you want to neutralize the effect that the exchange rate may have on a piece of equipment that you're going to take receipt of in the future. You know the value today, but exchange rates could go in any direction. You want to lock in on today's price rather than be subject to whatever FX says you're going to purchase, right? What the purchase price will be in the future. So these would be fair value hedges to lock in value. You would recognize any gain or loss as part of net income. If this is done right, the net effect is zero. And the term that's used is it an effective hedge? Effective. If the hedge is effective, then your net effect of the derivative will be zero. That's if you fully hedge the risk away. So you're not looking to make money through this. You're just looking to protect yourself. That's if it's effective. A cash flow hedge. You're protecting cash flows. So instead of protecting the value of an asset, you're protecting a series of cash flows from changing in the future. Or let's say you're a producer of whiskey. You gotta give credit to wine and whiskey producers. You know, they're developing something now that's going to be purchased in 12 years, right? Or 18 if it's a better one. And you want to protect yourself against fluctuations in the value of whiskey far into the future. So you hedge against that through a cash flow hedge. Cash flow hedges would go into other comprehensive income, except for any ineffective portion. What's ineffective? That's the part that's not a true hedge. That becomes net income immediately. A word by professional judgment. Right? It's hard to figure this out. So.
Does ineffective include a gain?
Say it again.
Does ineffective
gain or a loss. Yeah, either way, either direction. So FASB requires disclosures on derivatives. You need to disclose the book value, the fair value of all your financial instruments, including derivatives. You define your strategy. So are you a speculative investor in derivatives, or are you doing it for fair value or cash flow purposes? And you would show any net gains or losses. And that's the amount that's not effective. So, I won't go through all of this here except to say that the notes are extensive as related to derivative transactions. So let's turn to page 1037 in our text. And let's see the notes that Pepsi has. It's their note 9 and 10 related to derivatives. Note 9 just talks about their debts and their commitments, but if you turn to page 1038, it talks about interest rate swaps that it might use. It also talks about off-balance sheet arrangements, and Pepsi says they don't do off-balance sheet. They're not trying to do that. So it has a note on interest rate swaps. It does use that. And they did the swap to change a fixed rate item of debt to a variable rate. That was their choice. They wanted to get out of a fixed rate. In note number 10, they talk about their risks, commodity price risks, things of that nature, and how they might use derivatives, futures contracts, to lock into prices for the commodities that they're purchasing. And interest rates. So the notes will be extensive as it relates to derivatives. Yes.
What would you use the speculative investment on? The fair values for an asset and cash flows to protect your cash
Right.
flows.
Well,
What would you
who
use?
might use a speculative investment? Investment bank. They're in the business of trying to outguess the market. They have more knowledge. They have, they're buying and selling these kinds of instruments with the expectation of making money off of them. Very few companies should be doing it speculatively. So there are quite a few accounting quality questions related to derivatives. The periodic mark-to-market. A lot of room for error, manipulation. Enron, AIG are two examples where that mark-to-market challenged the marketplace in a big way. Quite often firms have the choice of whether to classify as a fair value or a cash flow hedge. Remember, cash flow hedges go to net income later because they go to other comprehensive income. So therefore, you might have a preference to do one rather than the other. Now, if you're effectively hedged, these numbers should be small. The gains and losses should be small. In fact, if you're seeing as an analyst large gains and losses due to derivatives for any of our companies, because we don't have any financial services companies, that should be a flag. That means they're not effectively hedging. They're kind of in a speculative game, whether they intend to be or not. And you might want to consider the implications of that.
What do you mean by large? Like how because the numbers of these firms are.
Well, large is it material? Is the amount of the gain or loss great compared to the total amount of the derivatives contracts? It's subjective. As an analyst, you have to figure that out. There's no magic number. But if they're using their derivatives ineffectively, you should look at it. And then you also have to decide, if you see, let's say they have gains from their derivatives, what's your expectation for future forecasting on those gains? Do you think they're sustainable? Do you think that maybe it was some good luck over the past few years, but you probably don't want to include them going forward? That would be a choice you'd be making as an analyst. Okay, that's all I got for you on derivatives. Retirement benefits, pensions. Pensions. So there is more than just pensions, by the way, in retirement benefits. Retirement benefits include pensions, but it also has things like ongoing health care. Some companies provide health care even after you've left. The general nature of any of the retirement benefits are they're accruing during your life of employment. And the longer you work, the more you get. And they become useful after retirement. So they're not to be used immediately. The employer is expected to recognize these costs as an expense while the employee is working and contributing to their revenues. So it's just the expense of labor, if you would. Now, here's the thing. You don't really know what the cost is going to be at the end, based on a lot of actuarial speculations. You have assumptions on employee turnover, future compensation levels, what future health care costs might become, etc. So I'm not really sure how much they're going to cost overall at the end. Now, pension plans have their own books as well. There are two types of pension plans. A defined contribution plan, relatively easy to account for. Defined contribution. These plans are such that the employer agrees to just donate, or not donate, to contribute a certain amount to a pension fund each period that you work. So they're contributing to your personal pension fund, and it's growing while you're working. The amount you receive depends upon the amount that was contributed in, and then the performance of that fund. So this is relatively easy because the amount that the employer is contributing it's a known number each period. These still exist, very desirable. more and more companies go to defined benefit plans, where defined contribution plans, the amount that the firm is contributing is known. Defined benefit plans, they can contribute anything they want. At the end, you're expecting to get a certain benefit, and you hope that there's money in the plan to give you that benefit. So for defined benefit plans, the employer is agreeing to make payments upon retirement based upon some formula of your wages earned and years of service, etc. The employer is expected to contribute appropriately to ensure that the plan is funded. It's not always done right, and we'll talk about that. And the money that's invested into the benefit plan is then invested by a trustee to that plan. He's trying to make the right investments. Two of the largest investment vehicles in the country are CalPERS. How many of you have heard of CalPERS? And TIAA-CREF, essentially union contributions. These are very, very powerful funds that have lots and lots of money and actually help to make sure that the companies that they're invested in are managed the way they want to be invested. They were critical players, for instance, in J.P. Morgan recently. Everyone followed J.P. Morgan, where they were just trying to decide whether they could keep the CEO and the chairman as a single entity. They voted against it. They lost, but they voted against it. And the feeling was that because they were so powerful, they'd be able to change their result, but they weren't able to. So it was J.P. Morgan. So these assets that are put into the fund and then invested don't show up on the balance sheet of the firm. They show up on the balance sheet of the pension plan, which has its own financial statements. But the firm has obligations for pensions. Now, for a defined contribution plan, the first time, those obligations are satisfied each period where they put money into the plan. Your defined benefit plan, they increase over time. They increase as the employee's salary increases. So at a given point in time, you're making a certain amount of money. There's an expectation that you're going to continue to work for the company. Your salary's going to go up. Therefore, your benefits are going to go up as well. So as an employee moves closer to receiving their benefits, the present value of those benefits increase. Just the number of years between you and benefit decreases. As payments are made to employees, the assets and liabilities decrease in the pension plan because you paid out cash, and the amount that you owe goes down because you paid out. So money comes in, money goes out to these pension plans. Now here's where things get a little sticky with pensions, and there are some fairly famous cases of underfunded pensions. Much like there will be potentially underfunded Social Security, which is really a pension plan for everybody when you get down to it. So here are a few terms related to pension plans that we should know. A VBO, a vested benefit obligation. It's the present value of the amount that employees will receive, whether or not they work another day. So today, you worked a certain number of years, you've accrued you're vested in a certain amount of pension. Right now. Compared to these, relatively small. The ABO, the accumulated benefit obligation. It's the present value of benefits that employees have earned as of the balance sheet date based on their current salaries. Okay? Somewhat similar to the VBO. The present value of the benefits that they've earned. Now the PBO is really what matters. projection going forward. It's the benefit that employees have earned as of the balance sheet date based upon future expectations. This is where actuaries come in. This is the amount that a company really should be thinking about. This is what we're going to owe based upon actuarial analyses. So PBO is the best estimate of future liabilities. Now, actuaries do the best they can, but there's going to be gains or losses compared to what the actuaries do. Of course, there are going to be change in assumptions. Turnover rate, retirement date, discount rates. A lot of things change over time, so the actuaries do the best they can. There will be gains and losses from the actuarial work. But let's focus on the ABO versus the PBO. This is where companies get in trouble. GAAP requires companies to disclose the funding status of their pension plans each year and any change in status. So the idea here is to see whether the plan is well funded or not. So again, since we just did it, go to page 1034, you can see Pepsi's disclosure on their pension plan. And we won't go into great detail on it. But they show a lot in terms of the performance of their pension. And this is an older book. It talks about it in terms of the Medicare Act, because it's also ongoing health care benefits. Okay? So there's a requirement to disclose how well the pension plan is doing. Now, the true economic definition of whether a plan is well funded or not, whether it's underfunded or overfunded or appropriately funded, is how much money it has versus the PBO, the expectation of future payouts. The PBO. If the assets are less than the PBO, then it's underfunded. But because the PBO requires all of these actuarial assumptions, GAAP or FASB does not require companies to use the PBO as the basis for what they report. It requires the ABO, because it doesn't require those actuarial assumptions. But the ABO understates what their liability is going to be, by definition. So a company will look like they're well-funded vis-a-vis the ABO, what's reported, when in fact they're underfunded. So you really can't see the funding. How many of you, about 4 years ago, flew United Airlines? Anyone? I did. Does anyone remember what it was like? I went to the airport. They were the angriest employees you ever saw. It's true. They hated their company. They hated their job. And then they got bought by Continental, and I think it's all good now. It's a different United now. It's really Continental. It's called United. But 4 or 5 years ago, it was United, and their problem was they had an underfunded pension plan. The employees knew it. And on top of that, the executives took money from the employees' pension plan to make sure that the executive pension plan was fully funded. And the employees were yes. And I'm telling you, they were the angriest people you ever saw. You couldn't ask them for anything. They took it out on the customer. Yeah, and you don't want angry employees flying your airplane. You want them to be happy. So, but they worked it out with Continental. So, the funding status of pensions is a big deal. It could be a drain. Okay, just going to other post-retirement benefits. They're not treated quite the same way as pensions because they tend to be smaller in amount. But you still do record the expenses while the employee works, but you don't need to fund them. They're not managed the same way. But you should be seeing it in the notes, what the liabilities are. I think you can see it in Pepsi's notes. So what do you do as an analyst with pensions? If you can figure out that it's underfunded vis-a-vis the PBO, you can create that as a liability. It's money that they owe, the company owes to the pension plan. And that's an additional liability. That's one option of what you can do. Another option of what you can do is consolidate the pension plan's financials with the parent company, treat it as a consolidated statement. What you could do, but you need to recognize that the employer does not have access to that funds. Right? You might be putting cash in, but the employer doesn't really have access to that cash. So you need to be careful when doing that. Or you could reconsider the actuarial assumptions. I don't think any of you are going to do that. You do actuaries. So I think for the purposes of this class, we're probably not going to do too much of this. But it would be good to understand in the notes where they stand for your companies. That's interesting. Okay. That's liabilities. Any questions? Yes?
Not really a question, but just a comment for part of the discussion. Over the last several years, I've read a few articles that attribute the rise in the global markets to two factors, one being global easing, and the second, even a few years ago, we were seeing that a lot of the major corporations were underfunded, but for the projected, for the future.
For the PBO, yeah.
Yeah, and that money in these last 2 years is starting to make its way into the market, into investments. It's part of the reason we're being propped up or going upwards.
So
that's also analyst opinion. It's not the fact,
right.
But from a conceptual standpoint, you can see it happening.
So I'm not sure. So you're saying that they were underfunded, but the underfunding is becoming less?
It's still severely underfunded, and that's going to continue to play out. But yes, they're starting to put the cash to work. You know, they've been making a lot of money in a lot of different companies that are publicly traded, and they have been hoarding the money, not really knowing where to put it, what to do, what's the best use of it. But they're starting to realize that their pensions are underfunded, and they're kind of contributing that way, and I think it's making its way into the market.
Wow. I mean, there's a lot we can talk about. You know, the markets and why equities are so strong right now, and the main reason is because of the Fed, keeping
easing.
Yeah, Fed easing.
I just want to get your take if you believe that that could be a factor.
Well, clearly, if the underfunding is less, it's because they're invested in stocks, and stocks are doing well because of the easing. Yeah, I think that's a factor.
I figured it's a financial reporting class, so the markets are the backdrop. It might not have been too bad of a point.
Yeah. Okay, good. That's good. Which is a good segue. Good segue to what we're about to talk about. So for the last 2 or 3 classes, we've been talking about accounting kinds of issues. How many of you kind of knew all of this, and this is at best a review?
What was that?
Well, not all of it.
Not all of it.
Not all of it.
A lot of it.
Content was reviewed.
Stuff we've talked about the last 2 or 3 classes.
Yeah.
For the most part, it's a review, right?
Yeah.
I'm hoping it was. Hoping it was. But, it's kind of, we have to go through it because it brings everyone to the same level. We are now at an inflection point in our class. We're done being accountants. We get to start to become financial analysts. That's right.
You want to do financial?
I'm not sure if we should clap.
Well, you all chose accounting as a profession, so you should boo, because this is the rest of your life.
Yo, he manages like 16 billion.
So we're going to go, well, we won't finish chapter 10 today, we'll finish it on Friday and we'll start chapter 11. So we're going to switch into forecasting, forward-looking on financial statements. And then go from forecasting into valuing a company. But really, a company's value is based upon expectation of future cash flows. That's really what it's all about. Expectation of future cash flows. Because that's how you bring future value to investors, and that's how investors can figure out how much the company, investing in the company is worth to them. But it starts with forecasting. Now, a couple of rules of thumb that we'll use as we forecast. First, we'll only forecast 5 years into the future. Sometimes you'll see forecasts of 10 years. The trade-off is it's more work to do 10 years. There's less, you can't really be sure 10 years out. You can't be sure 5 years out, but the more further out you go, the less sure you are of your forecasts, and they become less valuable. And so we'll use 5 years as a reasonable period of time. And there's something called a residual amount, a residual value that will take care of everything past 5 years. We'll do 5 years of analysis. Let's be clear that forecasting is an art, not a science. Right? That's where you wear your analyst's hat and hopefully have good, possibly heated discussions within the group as you figure out what the right forecast is. Hopefully, whatever you choose is based upon some, good economic basis. We will do forecasting at the detailed level, account by account. You don't just say, hey, net income this year was 1.2 million. We expect to grow 3% on net income every year. Therefore, our next 5 years of net income is whatever that becomes. We will forecast every single account on the income statement, on the balance sheet. And we'll do each one of those separately. What else do I want to say about it? It's an iterative process as you forecast. You're going to come up with a forecast. It's not going to quite fit. You're going to have to fix it. Because once you do things on an account-by-account basis, remember that it all has to balance in the end. Assets have to equal liabilities plus shareholders' equity. And if you do it account by account, it's not going to balance. You're going to have to do some things to fix it. And then when you fix it, you have to make sure it's realistic and it does balance. And it's going to be iterative until you get to it. The good news here is that FSAP, a tool that's at best been annoying up until now, starts to become your friend. It does some of this stuff for you. That's the good news. As we talk about the account-by-account balancing, there are really 3 models that we use. It's going to seem like everything has its own model, but it's all based on 3 basic models. You base off of the growth in the expected growth in sales for those 5 years. So you base other accounts directly off of expected sales growth. You might base some accounts as a percentage of total assets. There's another model. And the third model is you kind of look at the total days that sales are held in blank, and blank could be cash, for instance, and then you use that as a basis, as you expect that number of days that sales are held in cash to remain constant over time, and that will allow you to forecast cash going forward once you know sales. So it's very closely related to growth of sales.
Professor, what was the first one? The first one?
Just total sale, if you the growth in sales.
Growth in sales.
Growth in sales. Directly. And we're going to talk about these in a lot more detail. And it's going to seem like there are 12 different ways, but they're really all one of these things. How many remember back to like cost and management accounting? I'm talking about master budgets.
Mm-hmm.
Forecasting is really master budgeting, just into the future, right? Do you remember what master budgeting was all driven on? What do you figure out first?
I forgot.
Yeah, I know.
That was years ago, man. I took cost accounting.
What's that?
Oh,
It was years ago, right?
Yeah.
It's driven off of sales. First you forecast your sales, then you figure out expenses, and you work your way down from sales. And we'll do the same thing. It's a 7-step process to complete the forecast. Differentiate that from the 6-step process here. So the first step is to project sales. Then you project expenses. Then you project your assets. And then your liabilities. Once you know your assets and the liabilities, you can then project your shareholder equity and retained earnings and stuff like that. Well, before you do that, before you do that, you need to project your interest expenses, because once you project the liabilities, you'll start to know how much interest you have to pay. And so that has an effect on your shareholder equity and retained earnings, because interest will be another expense. And ultimately, you get your balance sheet into balance, and you get your balances of the income statement. It all feels good. Then you can project your statement of cash flow. And that's important because as we do our valuation, one of the models we use to value the company is from the statement of cash flow. And it's a good value model because while we do accounting as accrual accounting, it's all really about cash at the end of the day. We don't care what accounting says, we care what cash. Someone raise their hand.
No, I was going to say, for operating expenses, is it like probably has to do with the growth of the company sales and then just adjust the expenses? Is that how it is?
Yeah, but remember, operating expenses have a fixed component and a variable component. So if you just did it purely based upon sales, then it's assuming all variable. So it's not as simple as all.
Yeah, rent is going to be the same no matter how it's
Or it's going to have a step function. You need to say, wait, we're going to have to purchase a new facility, or, that's part of the process. Let's get started on this. Let's see how it goes. See how far we go with it. I think I said this, but the reason we're doing the forecasting is we're trying to figure out a value for a company, and value of any economic resource, in our case, a company, is a function of the expected future returns that resource is going to provide. So we're going to value the company based upon its expected future returns. And so our forecasting is our basis for being able to do that. And we're going to have to forecast all three aspects: operating, investing, and financing. And then as we do our valuations, there are three models that are fairly similar, but they have different bases. We will value based upon dividends, cash flows, and earnings. Each of them has a strength and a weakness. We'll talk about that, chapters 11 through 14, or 12 through 14, really. And ultimately, through all that, we come up with a share value, which we'll then share with the class and tell everyone whether to run out and buy some stock. And I'll tell you right now, no matter what anyone in this class says, don't buy the stock based on what we say. Don't, because we're just learning the process. Okay, so it's a little subjective here, but forecasting is the most difficult step because you're living in a world of uncertainty. you're taking guesses, you know, who knew that 2008 was going to happen. Your goal is to not be biased. Don't be optimistic, don't be pessimistic, just be realistic to the best of your ability. And you should be comprehensive. You should be internally consistent and externally valid, meaning your financials need to consistently match each other, and your assumptions about the real world should be reasonably valid. Empirical data shows that if you're a good forecaster, you can make a lot of money. Right? That's what some people. You're right. If you can simply identify the direction in the change in earnings, or earnings going to increase or decrease going forward, if you can forecast that from year to year, you'll have a 19% return on your investments. If you just directional. Now, if you could identify which companies are going to improve the most, if you could forecast that for the top 10%, you can average a 50% return on investment. So, analysis, detailed analysis is the way to find these opportunities, right? It's not based upon guessing the market. Not going to go through this slide. You're welcome. But this is really just the 7 steps. And it's in the text. Just wanted to show you the text. It kind of explains the 7 steps in some detail. We went through these 7 steps already. You project revenues, then you project expenses, then you project assets, liabilities. You project interest expenses, then you balance the balance sheet and make sure it balances with the income statement, and then you do cash flows.
So,
Yes.
in making our assumptions or our future progressions, we're going to be using the data that's provided in the balance sheets and kind of use the historical averages and things, or management's forecasts, or
No, you're not going to use management forecast. I mean, you will use historical values. You will potentially use management's forecasts as they're recorded in the notes. Right? The notes are a rich source of information for certain accounts. But you're not going to be looking for management's forecasts. You're not going to be looking online and looking in the news.
is, for example, I found that they had an investor day and the CEO quotes this and that. I mean,
That's not the intention of this class.
okay.
But yes, the best you can do is, the first thing you're going to do is make adjustments, right? Everything we did up until today was done with a purpose to give you all kind of the mindset to say, okay, we have the financial statements. What adjustments are we going to make to those financial statements so that we can then forecast going forward and have history that's reasonable to look forward from? So you're going to make some assumptions in that regard. So certain things to look at are, understand that the steps are interdependent, they're not sequential. And you have to go back and forth a little bit in this. It's not one shot and you're done. All of your financial statements need to sync with each other. As I said, we're going to look 5 periods into the future and then use a residual value past that. Now, the bottom line is you're going to do everything by account, and then your balance sheet's not going to balance. And so you're going to need to have some kind of fudge numbers in there. That's just the nature of things. And generally speaking, these fudge numbers will be the financial accounts, and hopefully they're not big numbers. If they are, you might need to look at some of your assumptions. So you might have to fudge in cash or equity capital or dividends or something to make it all work.
Try our best to keep it true.
Try your best to keep it true. Absolutely. So if you're really creating a huge cash balance, you might want to look into that. If you're creating a negative cash balance, that's probably not a good idea, because that'll throw off all your ratios. Remember, you're using this not only to create a value for the company, but also to create a statement on whether it's a worthy credit situation. So if you fudge too much, it's going to throw off the ratios. Okay, let's do step one. Oh, before we do. So your forecast will depend upon the industry factors, your assumptions about the industry factors. This is where you look at the 5 forces model, you look at your company's strategy within the model, look at economic conditions, expectations for future economic conditions, risk, etc. This is where they all come together. You'll use historical ratios and common size and percent financial statements, so that as you look forward, you want to make sure that your results are reasonable compared to the past. Right? You don't want your ratios to be way off going forward, unless there's something that's changed dramatically with your company. If you look at Pfizer, once Lipitor went off the books, that might have changed things for Pfizer. Okay, projecting revenues. Let's do it. You'll use both the price and the volume of historical sales as a basis for future sales. Some industries use other metrics as well. I heard today talk about new stores, square footage of store. We talked about that with Walmart. Airlines use filled seats, number of seats available and filled. And so if you can get the information about historical trends in these kinds of metrics, you can use that information looking forward for the retail industry or for the airline industry. You should consider capacity constraints, access to raw materials. Certain industries have greater capacity constraints than others. The cyclicality of the industry, the technological advances, where in the life cycle is that industry? Is it growth? Is it mature? Is it in decline? I'm not sure any of our industries are in decline. I can't think of any that are. But some are very mature as an industry. And then inflation, exchange rates, potential for recession, again, etc. So you need to think about all these things as you forecast forward. Sales. Segment by geography and product line. Let's take Pepsi. We talked about it the very first day. Pepsi has a static business, non-mature business in the United States, and overseas it's considered a growth business in many markets. So the cost of doing business in the United States has a different profile than the cost of doing business overseas. And so to the extent that you can segment your businesses, both on the revenue side and on the expense side, you can then get a better sense of your profitability. And to the extent that you have significant ownership in non-consolidated businesses, but it might have an effect on your business, you need to think that through. Because Pepsi's ownership of its bottlers increasing a lot, what's the increase on that? That's its own, it might be increasing at a different rate than Pepsi's own business, faster or slower.